Welcome to the Lend Academy podcast, episode number 99. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Milind Mehere. He is the CEO and co-founder of YieldStreet. They're a company that I've been tracking for some time now. They're a very interesting company offering a range of different investments, all sort of asset-backed investments. So I wanted to get him on the show, talk about the traction that they've been getting, also talk about this new area that we've really never touched on before on Lend Academy, and that is litigation finance. So we go into some depth about that. We also talk about their approach and their focus on the individual investor and all the kinds of investors that they are attracting here on their platform. We also talk about technology, where they've really, Milind has a technology background and has really implemented some pretty advanced technology in their business. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Milind.
Thanks for having me.
Okay, well, let's get started. Looks like you've had a pretty interesting career to this point. So can you give the listeners a little bit about yourself and what you did before you started YieldStreet?
Yeah, absolutely. I would be delighted to. So I was a co-founder at a company called Yodel, which was a marketing platform for small businesses. And we scaled the company to about 200 million in revenue. And last year we were acquired by Web.com. So I spent about 9 years there in a variety of different operating roles, including product, biz dev. I built and managed large sales team and build our Canadian business. So I have deep operating background. And prior to that, I worked at a number of different startups as well. So being a tech entrepreneur has been in my DNA. And I always look for interesting projects that are cutting edge and have wide impact. And so if you look at my career, as you mentioned, it's always been trying to make an impact where I can reach a wide range of constituents.
Okay, yeah, fair enough. So then what was it then that caused you to, or decided, what was the sort of the germinating idea that caused you to start YieldStreet?
Yeah, it definitely has an interesting story. Being an ad tech guy for 10 years, right? I understood data and optimization really well and advertising yields and CPMs really well. I personally feel that investment or wealth management in our country is broken. 99.5% of the population does not have access to good fixed income products. And we want to change that by bringing Wall Street to Main Street. And the reason for that is that I was one of those 99.5% people. Though I was extremely successful, I was overexposed to the stock market. And I loved the concept of fixed passive income, right? However, I had no access and the minimums were too high to really get access to good quality private equity or good quality operators, right? Then there was no way to judge these originators or operators and no institutional way to buy it. On the other side, my co-founders, Michael and Dennis, were excellent investment risk managers with, 30 years of combined experience, and they could not access retail channel because they could not scale it. But they had access to excellent supply, and they wanted to consolidate the fragmented the market, right? So Michael came, and I think Michael spoke at the recent Lendit conference as well. He's an expert in asset-based lending, has 10 years of experience, stellar track record. Dennis is the chairman of a federally chartered bank, so understands risk and compliance very well. So we thought that this was a perfect harmony to kind of bring tech and finance together. Plus, as you know, more than anybody else, you help create this market, right? It's a massive market opportunity, and our missions were aligned. So that's really where the idea for YieldStreet came about, is that when we said, hey, why don't we put this up, into a marketplace? And when we looked at the overall alternate lending ecosystem, nobody was doing a horizontal asset-based marketplace. And so we thought we could create this service to open access to millions of people.
Okay, so then you have obviously some complementary skills. It sounds like the three founders have, you've got some nice complementary skills there. But so it sounds like you decided, on real estate, obviously, which is the most popular asset-backed investment there is, and obviously very well established, both online and offline. But then, why don't you just tell us a little bit about what YieldStreet does on what sort of deals? Because I know you also do litigation finance, which is what Michael spoke on at Lendit, and I want to I want to dig into that in some depth. But why don't you just tell us first about what was the instigation behind the different verticals that you went into?
Yeah, absolutely. So what YieldStreet does is very simple. We generate yield, right? And the way we are doing that is by providing investors access to asset-based investments across different asset classes, like you mentioned, real estate, litigation finance. We do also commercial loans and receivables finance. And typically, these transactions would have been done by sophisticated PE firms, right? So at the core of our investor philosophy or investment philosophy is the focus on principal protection, and that we do via asset quality and making sure that we are senior secured position in most of our investments. And also a reminder, right, like some of these are commercial quality opportunities where individuals would never have access to these type of investments with attractive yields and low market correlation, right? Mm-hmm. And the reason, so if you think about, right, like in our investments, we have hundreds of investors investing. People who are putting $5,000, $10,000 are investing alongside with people who are writing high six-figure, seven-figure checks. These type of things have never happened in the past, right? And so they're getting the same access regardless of the size of their investments. And we see a great distribution of investor type and things like that. And so the types of investments we've done is, you could invest in a New York skyscraper or a group of condos in Brooklyn, or you could participate in financing a portfolio of Uber cars, or participate in a loan to an NBA athlete, or do litigation finance, as you said, right? A portfolio of litigation finance. At the core, again, it's all about understanding the asset quality and principal protection. The second part of your question is the reason why we chose this asset class is obviously we wanted to start where we had a competitive advantage and a significant moat. And litigation finance is something where Dennis and Michael are pioneers of that asset class. It's been done for the last 2 decades with institutional investors, hedge funds, etc., but was never done in a retail way, the way YieldStreet is doing it. So that's our core competency. So obviously it made sense to do it. And along with that, they also have, my co-founding team has experience in real estate as well as, commercial loans. So the asset classes that we chose really had 2 criteria where we had core expertise that we could use to kind of build our technology and data. And number 2 is we had access. So as an example, we have looked at close to $700 million of opportunities in the last 2 years since we launched this. So we have tremendous access to supply in these asset classes, and that's why it made sense for us.
Okay. So I just want to talk about litigation finance for a minute because the listeners, there'd be many that would not know anything about it. I mean, I knew virtually nothing about it until about a year ago, and I've since found out about it, and I'm actually very intrigued. I think it's a fascinating opportunity. But can you explain what it is? Because I know there's different types of litigation finance. So explain what it is, what you guys focus on, and maybe provide some examples so that we can really, better understand exactly the kinds of deals that you do.
Yeah, absolutely, Peter. That's a great question, and you are among a lot of people that don't So it's not that it's an anomaly. A lot of people don't know about it. So litigation finance, in a simplest way, right, has 2 or 3 different categories. An easiest way to understand it would be pre-settlement financing. So this is a case where, let's say, a messenger was coming down the street, got hit by a cab, and he got injured and is out of work, and he needs money for his life needs, and his immediate choice is to settle with the insurance company for a fraction of the price versus he letting the whole process evolve through the legal proceedings, right? Because he doesn't have money for life needs, he could settle for a much lower amount versus if he had an advance that could pay his bills, get him back on his job, and then let the case or the legal proceedings proceed for 6 months, till the insurance company paid what was rightfully his for the injuries that were caused to him. Right. So in a simplest form, that's really, there are funding companies that fund plaintiffs, in anticipation of settlements that happen. So that's pre-settlement finance.
Mm-hmm.
Post-settlement is something where the judgment has already been given, right? So some high-profile example is like NFL concussion cases, right? It was a long running battle. About a year ago, NFL, the National Football League, agreed to pay over $1 billion to a variety of different players. But even now, the checks have not started because there is a long process between the time the judgment is awarded till actually people get paid. So in the meantime, these players are already in dire financial situation because average life in NFL is less than 4 years. So in post-settlement financing, what you do is you essentially give an advance to the plaintiff and bridge that time before he gets paid from the obligor or from the defendant. And so you can think of it almost like a bridge loan, if you will.
Mm-hmm.
The last category is law firm financing, and this is law firms. Many of the times work on contingency, as you know, and they need financing to work on complex litigation, such as expert witnesses, investigation, things like that. And so you're financing the law firm, and so when they get paid, your loan will be paid as well.
Okay, so then which of those three categories does YieldStreet, or do you do all three?
We do all three, but we do a lot of pre-settlement financing.
Okay. So that's where, and I what for me, just to give my perspective, when I first heard it, I thought it sounded a little dubious, to be honest. And then I spoke with several people in the course of actually putting that session together with Michael at Lendit, and really became a very big proponent of it because you've got this as let's just take that messenger who's lost his livelihood.
Right.
He can't work, and he could settle, as you say, for a fraction right off the bat, and that was when the insurance company wins and he loses. But what you're saying is get an appropriate amount, an amount that's commensurate with the actual damages incurred. And then he's going to go off and be able to live. He's got an advance basically, and he's able to live while the process works its way through. So, I think, whereas it sounded dubious, I think the whole thing is. I think it's a lot more admirable than I think is at first glance, and I think it's something that really is much more of a win-win. So, and the other thing that I guess this was also mentioned in the lender session is that this is this is a non-correlated asset class because a messenger is going to get injured on the streets of New York or any other city of that matter. It doesn't matter whether there's a recession, whether there's a stock market crash, whether the economy is booming. Those things will always happen. So is that, I guess when you're pitching it to investors, is that what part of the appeal?
Yeah, absolutely. So you nailed it. And I think just to add to what you just said, right? So that is one reason why it is non-correlated because, accidents and injuries or any types of these legal cases happen irrespective of the external economic factors. But the other thing is, think of the obligors, right? The defendants. These are big insurance companies, pharma companies, which are Fortune 500 companies, or local municipalities or government agencies. And they don't carry the same default risk as a small defendant would, right? And for them, it is more cost efficient to do the right thing by the consumer and settle versus an expensive legal proceeding. So those are really the two main things why litigation finance is perceived to be very non-correlated or low correlated to the broader markets.
Right. So, and then, obviously from both Michael and Dennis, you said have expertise in this area, because I feel like, I'm an investor. How am I going to assess the risks? Because I have no idea. I've got no idea whether this is a good case or the person is trying to scam the insurance company or what. So how do you underwrite these advances, and then how should an investor really assess the risks?
Yeah, absolutely. So that's a great question, Peter. So this is where it gets really interesting, right? And so just taking litigation finance as an example, right? So our philosophy is to work with originators that have deep expertise in their asset classes. So for litigation finance, as an example, we work with Law Cash amongst others who have a proven track record. They've been in business 16 years, funded over 120,000 plaintiffs, close to the tune of about $500 million, right? And so they have audited financials and the history. And they have a very solid underwriting process, right? And they look at a variety of different factors. And they're confident that obviously they're funding this on their balance sheets, right? And so they're closing and giving money to the messenger, as we discussed earlier. And their underwriting criteria depends on where the case is originated, who the obligor is, who's the law firm representing the case, what's the value of the case, what's the jurisdiction, all of those things. And they consider all of those factors in their underwriting criteria. Now, what we do then is we do a second level of underwriting, right? And so what we're doing is we are not taking one case at a time. What we do is we take hundreds of cases, so between 50 and 500 cases, and put them in a portfolio. And we use historical data, and we are beginning to use concepts of data science and machine learning to really understand what would be the outcome of this portfolio if we configured it, taking a combination of different case types, different jurisdictions, different obligors, to almost kind of create, if you will, a basket of, if there is an equivalent to equity market, it would be a basket of like ETFs, right? A variety of different cases. So I think that's really where this is getting very interesting, and we are now trying to productize this using data science. And so that's really where, from an investor perspective, to answer your question, because these are put in a portfolio that are cross-collateralized, so let's say you have a portfolio of 100 cases and you lose 5 cases. It doesn't really matter because it's cross-collateralized against the other cases. So our investors will get their fixed return or coupon first. So if it's a 13% portfolio, they'll first get their principal and interest back before the originator or anybody else makes any money. So that's really where it is very fascinating with the innovative product that we have created in the marketplace. It's one of the first products of this kind that you will find in any of the peer-to-peer lending ecosystem.
Right.
So that talks a little bit about how we do the underwriting.
Okay. So you've got on your website, on your homepage, it says quite prominently that, $0 in principal loss. So that's obviously a great track record. So can you just tell us when did you underwrite your first loan, and how long have you been doing this?
Yeah, so this is a great time to have this podcast because we just finished 2 years. So we launched in April of 2015, right? So we're just 2 years into this. And so we've been doing it for the last 2 years. We've done over $100 million. So we are at around $106 million of loans originated on our platform.
Okay, and how's that broken down between like the litigation finance, commercial real estate, other real estate? I mean, what is, or commercial financing, I should say. How's it broken down?
So Peter, right now, I think broadly speaking, it's about 50 to 60% in litigation finance, about 20% in real estate, and then 20% in commercial kind of small business loans and receivable finance and some other categories. Okay. So that's really the breakdown. Yep. Okay,
so then let's talk about the investors, because it sounds like this has really been the impetus, and when you really talk about on your website, you talk a lot about the investor, and you talked about you even mentioned earlier in this podcast that the whole idea was to democratize this access to alternative fixed income investments. So who are the kinds of investors that you're working with today?
Yeah, so Peter, I'm really proud to say that all the money that we have raised on our platform is 100% retail, right? So the $105 million that we have raised has no institutional capital. So these are mostly accredited investors and a few family offices. And, just to give a little bit of a favor, we have over 10,000 investors from all the 50 states. And 66% of them are in multiple investments. Our average investor portfolio is about 160,000, but 75% of our investors are less than $100,000, right? So there is a lot of diversification. And I don't know if you have been tracking our platform, but for since last 2 quarters, demand is reaching fever pitch, and we're really excited. I mean, we have closed $2 to $5 million investments in matter of minutes. So demand is really, really high. In fact, Q1, I'm just about to pull data, but I think for almost 75% of the time, like calendar time in Q1, we had nothing open, because whenever we used to open a deal, it would be sold off in like minutes or hours.
Right.
So we are really excited about that, is to be able to make this available, broadly to people.
Right. So that I can see that's part of your mission. So do you will you make yourself available to institutional investors, or are you still focusing on building it up with retail?
Yeah, so I think our investor segment will go from retail all the way to institutional. So we are actually in the process of onboarding our first financial advisors in Q2, and those will essentially come and we have a product where they'll buy on the platform, but they're buying on behalf of their clients, right? So these are registered investment advisors, or FAs, so that would be our first step. And then we are talking to several hedge funds as well as institutional funds to do an asset purchase and hold. So that what that would mean is that they would buy in conjunction with the retail investors and just hold that paper, on for their fund. And then lastly, another way that we are going to work with institutional investors is for obviously raising our warehouse line. So one thing that YieldStreet does is that we close all these investments on our balance sheet,
right?
And before we put it up on the platform, and we will be raising a warehouse line, and so I think that's really another area where we will collaborate heavily with the institutional investors. Right.
And so, as far as the investors go, you know, on your website you show 14.8% return. Is that sort of your expectation? I mean, what do you tell investors when you're having a conversation with them as far as yield expectations?
Yeah, so Peter, generally what we look for is about 8 to 20%. That's the general range, and so our investors should expect that. The lowest deal we have done is 9% on the platform among the 52 transactions that we have done. The other thing also is a slight correction that I want to make. So we are not talking to investors, right? So a lot of it is, so we have a very small investor success team. And the idea here is to make everything so transparent and so easy. And so we have put in a lot of tech resources and effort to make the process extremely seamless, but at the same time appreciating the fact that this is people's hard-earned money, right? So obviously that's why we have people on the investor success team, including myself, who are always available to investors. But the idea is to make it so transparent that you should get 90% or 95% of everything through the online interface. And then obviously there will be some investors who will obviously want to make sure that there is a warm body, especially as we are building trust and credibility and the brand, that there is real people behind it, and we are always obviously available for them.
Yeah, that's what I mean. When you're taking investor money, even if it's a $10,000 check from an individual investor, then sometimes those people want to know that you're not some Nigerian scam that have put up a website. So I think so.
Correct.
Yeah.
Yeah, absolutely.
So I want to just talk about your business model. I mean, how are you actually making revenue?
Yeah, absolutely. So, just to round off your previous question, right? So one thing I want to just point out to our listeners is that we are, in fact, an SEC registered investment advisor, and we've been one since April of 2016. So obviously we are under the purview and governance of the SEC. Now, in terms of the revenue model, Peter, currently the revenue model is fairly straightforward. We have two types of fees, which are transparent and open on the platform and in all our docs. We have about a 2% management fee on the declining principal balance, so that's a recurring revenue model, and we also charge an upfront listing fees sometimes, and it's a flat fee.
Okay. So that's similar to the other platforms out there. Okay. So I want to focus a little bit on technology because it's obviously your background, and you make it clear. You said it a couple of times in this interview, and you make it clear on your website. You're powered by technology, driven by expertise. So, can you just talk about what are some of the things you've implemented on the technology side, and how are you using technology in your business?
Yeah, absolutely. So I think this business, Peter, fundamentally would not have been possible if it had not been for technology and data, right? And the amount of transparency, the amount of ease of use that we can offer, this could never have been done, right? So there are a variety of different ways where technology is so critical for the success. So number one is investors, right? We have thousands and thousands of people who are logging in, right? And as I told earlier, right, like you have investors that are putting $5,000-$10,000 alongside with family offices and high net worth guys who are putting $1 million in the same investment. This would not have been possible if it wasn't for how we had our investor engine built, right? To date, Peter, we have made 26,000 payments to thousands of people. So as you mentioned, 0% loss rate, right? We have also returned over $40 million in principal and interest back to our investors. Again, like we have this incredibly automated loan engine that does all of this calculation, and you should appreciate it because this is asset-based lending. All the deals, and I gave you the flavors of the deals, right? They are slightly so different, right? And so the technology is able to comprehend that and bake all of that. Like, so you have various type of investors, different deal terms, different interest rates. Some interest rate gets paid monthly, other gets paid when an event occurs. Sometimes principal gets paid monthly, sometimes it gets paid at the end of the term. So all of that is built into the loan engine. Again, possible only because of technology. I spoke a little bit about risk engine, and I think we are now starting to use machine learning and data science to really understand historical performances of asset classes and really use that data to underwrite portfolios, which I think is going to really be a key strategy for us in the coming year. This is how we can take, industries like litigation finance, like hard money loans, and bring them to the main street, right? Because what we could do is use data and show all of these things, right? So, for example, one of the projects we are currently working on is if you are part of a portfolio, you will get real-time alerts on how the portfolio is performing and which cases got settled and how they got settled and how did it do compared to the predictive model that we had as to how this portfolio will evolve over time. So those are the types of things that are only possible because of technology. And so we are very excited to be using some of these concepts and being one of the first to market to do that.
Sure. So I know we're almost out of time. I've just got a couple more things I wanted to touch on here. So can you talk about the equity funding, your fundraising that you've made? I mean, how are you funded? Are you going out and raising another round? I mean, where are you at in that funding cycle?
Yeah, absolutely. So we have raised $3.7 million in seed round about 2 years ago, and it's so that is the only funding event that we've had. The business has scaled really well for us. So I am, as a tech entrepreneur, I don't know whether I should be happy or not so happy of what I'm going to tell you right now, which is in Q1, we were actually profitable a couple of months. and to be profitable this early was really a great validation of our business model, right? And in terms of growth, I think we're very excited. So we did, in Q1 of this year, 75% of our entire 2016 revenue. So I think we're super excited about that. So that's about funding. In terms of what's happening, the next step. So as I mentioned to you earlier, right, Peter, one of our big challenges right now is that we need, warehouse line because we have so much supply that we want to close and want to have consistent product available on the platform. And so one of mine and Michael's big focus is to, close a $100 million warehouse line shortly. And in tandem with that, we will also do our Series A, and we'll figure out how that works. But I think for us, warehouse is important because that's something that will help us to keep up with the investor demand.
Right, for sure.
Yeah.
So I just want to be clear. Right now, you're open to accredited investors. Do you have plans to open for individual non-accredited investors?
I would love to. I mean, again, going back to our mission, right?
Yeah.
I think we would love to. As you can imagine, we have we have so many projects to do and limited resources. So that is definitely on our roadmap. I don't have a timeline, but I'm hoping by end of the year or early next year. But ultimately, we definitely want to open that up. As you know, Fundrise and others have been leading the way in different ways that we could do that, and I admire them a lot. It's really innovative with the way they're doing stuff. So
okay.
Yeah.
So what else are you working on for the rest of this year? Tell us what's on your plate.
Yeah, absolutely. So I think I spoke a little bit about Risk Engine and how we want to use data and use machine learning to understand the past historical performance on these asset classes that was not readily available and use that to create portfolios. So I think that we are very excited about. We are also rolling out new products such as what we're calling as Auto Invest, which is a lot of our investors say that, hey, we want to auto invest without having to choose one investment at a time. So we are rolling that out as well. I think we have a lot of demand for it, and so that would be an interesting evolution for us. We will also launch some new investment products such as, like diversified fund. Either could be on a based on asset class, or could be across asset class, where you could, participate in 10, 12, 15 deals by making one investment.
Right.
So that's something that we will do. And then I spoke a lot about onboarding in some institutional investors, such as the financial advisory channel. And I think we are building technology to make that seamless. And, we will have some early customers onboarded in Q2. So we're excited about that as well.
Great. Well, on that note, we've run out of time, but I really appreciate you coming on the show today, Milind.
Thank you so much, Peter, for having me.
Okay. See ya.
Okay. Thanks.
I think it's great that investors today have more and more opportunities. Admittedly, it's mostly accredited investors that have these opportunities, but we are still moving towards a world where even non-accredited investors, we just did a post on it on Lend Academy a little while ago, have much more opportunities than they used to have. And it sounds like YieldStreet may be adding to that list. Certainly has changed a lot since when I first started investing, coming up on 8 years ago now, where it was Lending Club and Prosper and nothing else. I feel like today investors are far better served, and I think only going to become more so in the future. Anyway, on that note, I will sign off. Before I go, though, just another reminder, we've done 99 episodes now. I'd love to get some more reviews on iTunes or Stitcher. So if you haven't done so and you've been listening for a while, please, please, please go and put an honest review on iTunes or Stitcher. Helps other people discover the show and helps spread the word. Anyway, thank you very much for listening, and I'll catch you next time. Bye.